explain why a 70-30 can beat a 90-10? You're doing real estate and really value the ability to leverage your cash. Okay, this one might take a little bit of time. And it's pretty contentious. You've got a lot of people out there that are pushing the 70-30 design as if it's going to be better for you long term, even though it gives up a lot in the short term. You end up with basically 70% cash value rather than close to 90%. I mean, that's essentially what it turns into. The 90-10 is 90% goes to PUAs. 90% of your premium payment goes to PUAs. 10% goes to base premium. And essentially, that turns into cash value. Everything that buys PUAs goes to cash value. So it doesn't work exactly one-to-one like that, but it's close. So why would a 70-30 beat a 90-10? If it comes to policy design right now, the greater the cash value, when it comes to illustrations, the greater the cash value you have in year one, the greater the cash value it's going to be long term. So a 90-10 will almost always, in my experience, especially if you go company to company and you're not trying to compare different companies, but if you go company to company, the early cash value is going to beat long term a design that has a lower early cash value. So a 90-10 with Guardian is going to beat long term in death benefit and cash value a 70-30 design. With Mass Mutual, same thing. With Penn Mutual, a lot of these guys talk about a 60-40 split. When I do the illustrations on there, I can get an 80-20 split. So you don't have to get a 60-40 split. And the 80-20 split gets you, I think I can get you to about a 5-year break even, depending on your health rating, which is really good. And you end up with about 80% cash value. So I can make a really strong first year for Penn Mutual. Why would I want to design one at 60-40? I don't want to be too cynical here, but at 60-40, it pays me a hell of a lot more commission. Okay, Penn Mutual alone pays higher commission than any of the other companies, than any of those other companies that we've talked about. And it's not just because of the design. It's not just because I can only do at best 80-20. They pay a higher base overall, which is great. It's great for the agent. And long term, the illustrations show that it can perform well, even better than some of those other companies long term. A lot of that's because of the current dividend rate. Okay, all of the illustrations from whole life, they project out from the current dividend rate. So Northwestern Mutual, really low current dividend rate. It's like 5%. So when you compare an illustration for them long term against Mass Mutual, who has a 6.2%, it doesn't perform very well. Now, a lot of those agents don't design policies to perform like we do either, so it's never going to perform as well just based on the designs that I see come out of Northwestern Mutual. But if they were able to design it the same way, you would still see lower values just because that dividend rate is so much lower. Now, when it comes to when can an actual 70-30 design beat a 90-10, that would be when the dividend rates change. So what happens is if you do a design that is, well, there's something special that happens inside Penn Mutual policies. Not special in a good way. But when the dividend rates drop, you have the potential to have it become a mech, because Penn Mutual will not allow you to put more money into the policy to make up for the lack of paid up dividends that was projected based on the dividend rate when you started the policy. So what happens is some people start their policy, they'll max fund it, so they have no more room to put in there, and then the dividend rate drops. That dividend doesn't pay for the expected paid up additions, which when combined with the term insurance gets you to the death benefit and keeps you within this corridor of insurance. That policy needs to see that extra paid up additions that the dividends buy in order to keep the growth above the value of the policy. So what happens is you don't get that growth in death benefit. You don't get that growth in death benefit, which means your cash value has to be lower. Otherwise, your policy will mech. It doesn't mean that your policy is going to mech. What happens is Penn Mutual will contact you and say, hey, you're going to get a mech if you don't withdraw some money out of your policy. So worst case scenario in that, the dividend rate drops, you got to pull a little bit of your money out of the policy. It hurts the long-term growth, but no big deal. You're limited to what you're limited. You're still going to want to put in as much money as possible each year into the policy. Now, on the flip side, dividend rates go up. If dividend rates go up, most insurance companies tend to credit more of that dividend to the base premium than they do to the paid up additions that are within the policy. And any amount that you're paying in term insurance is going to be credited less because of the increase in dividend rate. So what we've been in for the last 20 years is reducing dividend rates. Dividend rates have been slowly coming down. That has to do with the overall interest rate environment that we live in and that we don't anticipate much change in the near future. Who knows what it's going to do in the long-term future? These policies are designed to live out, for 20, 30, 40, 50 years, sometimes more. Who knows what it's going to do in the future? It's possible if you're still paying premiums in the future there, when the dividend rates start to go back up, that you could see a greater growth in a policy that you've been paying a higher base premium towards. So that would be long way to get to that answer, but that would be how you would get more cash value in a 70-30 than a 90-10. But we're talking long term. Anything short term is not going to happen. If you are planning on just funding this for 7 years or 10 years, turning it into a reduced paid up policy and cutting out the drag of any new premiums, it's not going to benefit you to have a 70-30 design. You're much better off doing the 90-10. If you're in real estate, that early cash value can mean way more to you than potential long-term growth if dividend rates go up. When it comes to real estate people, when it comes to investors, and really how we use whole life insurance in general, we need to view it more as a savings asset. We're not getting into this expecting stock market type growth. We call it a savings asset because we expect a gradual savings rate. It's a good place to get some growth with our money that's normally sitting in a checking or savings account, our emergency fund money, money that's sitting around for capital expenses or waiting to pay other bills. It's a great place to store those funds. What we're planning to do with that cash value, though, is to earn our growth, to earn our interest and our arbitrage outside of the whole life policy. If you are looking for earning your growth inside of a policy, that's where the IUL comes in handy. So how often are we doing these Q&As? Every week. So we call it Wealth Care Wednesdays. Every Wednesday, I'm, at least for the foreseeable future, I have it blocked out. I'm committed to doing a live stream answering your questions every Wednesday from here on out. This was a question asked and answered during one of our Wealth Care Wednesdays live streams. If you have any questions, leave them in the comments section below, or join us on one of our Wealth Care Wednesday live streams where you can ask the question and we'll answer it on the air live. I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.